Give us 30 minutes each week to discover the trends that are shaping the future of retirement with That Annuity Show. We bring you conversations with industry leaders who are revolutionizing financial products, technology, and distribution channels. Now, here's your host, Paul Tyler.
Hi, this is Paul Tyler, and welcome to another episode of That Annuity Show. Bruno, good to see you.
Good to see you as well.
And coming live to us from Canada, you're charging us 25% more for your time on the show today. Is that right?
That's right.
Reciprocal.
Of the base we know. Yes.
Yes. All right. Well, listen, you re-recruited another guest, a returning guest to our show, and I'm so excited to go all in for MYGAs on this episode. So, Bruno, do you want to do the honors and intro our guest?
It would be a pleasure. It is my pleasure to introduce Jeff Affronti. He is president and CEO of FSD Financial Services for the last 3 decades, and a well-known figure in our industry and annuities and the retirement income space. Very active on social media. Jeff, welcome.
Thank you. Hello, Bruno. Hello, Paul. Hello, agents. Hello, everyone, as I open all my videos.
Yeah, we know. And it was, what other good reason to have you here is to kind of force me to watch a few of those of those videos. And I always feel like I learn a lot from them.
Good.
I see a different vibe, a different spin. And we're looking forward to talk more about that today.
Great, thank you. I appreciate your following on LinkedIn and your support there. It always keeps me going.
Yeah. Well, Jeff, I can't wait to dive in here. And we talked a little bit about your perspective on the market, which is amazing. But just kind of tell people, how long have you been really focused just almost solely on MYGAs? Is this
MYGA SPIA is where I started. My dad was in the business. He ran he was the national annuity director for Crown Life. We've been through that. And he just brought me in and taught me MYGA SPIAs. That's where I just started working with the agents at a very high level with the agents. And, we went in like that. They had a unique MYGA over there that you could pick a 0, a 2, or a 4% commission, and the rate would adjust, accordingly. And we're going back to the 80s, but,
right.
And I learned just listening to my dad and his friends talk about the business. And there was GICs back then too, the guaranteed investment contracts and stuff like that. But all basically guaranteed accumulation stuff is just what I've been doing literally every day.
Oh, okay. That's just interesting right there alone. I'm just going to, click into that. Wait a second, dial a commission for a rate. What was the calculus like? Because I could see, hey, dial it down, get a bigger amount, but I've got to pay my bills. I don't know how did people work it through?
It was agent's choice and their relationship with their client. It was on the rate sheet, right there on their rate sheet, the different brackets you could give. So it was just, we always went to the lowest one, of course, because that was the best rate, but other people will do it. It still exists today, only not in the same name. Like they'll have, MYGA 5 and MYGA 5 Plus, and they'll have 2 different rates and 2 different commissions, but basically be the same product. So it's a little cleaner that way, but yeah.
But it's just me. What's old is new. I mean, if I were an RA, right, I could have a different fee structure for you based on
how much premium
we're operating.
Well, I see the fee structures. If you have $1 million plus, it's 75 points. If you're 200,000, it could be 2 points. It depends. Yeah.
Okay. So, wow, did MYGAs have a great run over the last couple of years? Now it looks like it slowed down in the fourth quarter with some of these rate changes and stuff, but can I tell what does the landscape look like? If I'm a carrier, trying to figure out my product strategy, if I'm an agent trying to figure out, wait a second, I made a lot of money serving a lot of clients over the last couple of years. Where's 2025 headed?
Well, there's a lot of potential in the MYGA space for existing MYGAs or anything coming up for renewal. So let's think about it, right? If you wrote a MYGA 2 years ago, maybe you lock someone up at 365. If that's a big product, that's a qualified money, a lot of those have access features, 10% withdrawal. You can try and maximize the yields by doing partial 1035 exchanges or qualified money movements. That's one way. And definitely when they come out of surrender now, whereas in the past, hey, you're out of surrender, your minimum's 3, the new rate's 250. What would you like to do? Well, I'm staying Today, you got 365. The company's offering you 365 to stay. I got 540. Everyone's moving. And the great thing about MYGA clients is they're happy clients. They got exactly what they were told they were going to get. So it's not too hard to say, hey, you want to, and a lot of companies now are allowing internal rollovers. So you can get full commission and everything and a good new money rate. So that's the way insurance companies are keeping the money from leaving as well. And it's an opportunity for the agent to just simply go to the client and go, Mr. Client, you liked ABC company for the last 5 years. They gave, hey, they got a new rate. You just have to re-up for another 5-year surrender charge. Is that okay? They're all saying yes. They're all saying yes to this because why wouldn't they?
Obviously. And no, that's really good. And in terms, so you've posted a lot on laddering recently, which is a topic I love. First, can you take a step back for everyone, explain what annuity laddering is, and then we'll dive a little more in the details.
Yeah, the last video I did was on annuity laddering, and there's two things: it's growth, or finding a premium. So a ladder says we want to have certain buckets of money come mature at different durations. So it's a good way to foresee future rates and to capture things in the future as well based on holes in your portfolio. So basically what I said is, hey, if you go 3 years and you put 100,000 in at 3, 4, 5, 6, and 7 years, what will it each be worth? 3 years is 316, 4 years was like 420. And you can see, so in 3 years, I'm going to have this bucket come due. What do I want to do with it? So each year you're going to have a bucket come due with the growth. Or you can conversely back into that and say, hey, I want $500,000 in 3 years, 4 years, 5, whatever the term is. And the MYGA can tell you exactly the premium needed today to hit that target. So that's laddering. So you can basically have different buckets of money come mature at different times. And then that way, I know some people put all their money in one MYGA in 1 year. And then when it comes due, if MYGA rates are lower, if you're in a 30-day window, you're trapped at whatever the environment says at that time. Whereas if you have stuff coming due every year, you'll have some plus years, some minus years. But when you blend out, I bet you're close to 5% over a 30-year time frame if you do it that way.
Yeah, Jeff, it's interesting. Like I think people generally, investors, I think they understand trying not to time the equity market. I'm not sure that they understand they shouldn't try to time the interest rate environment either.
No, there's no way. Yeah. Like right now, a lot of people are like, what are rates going to do in the future? Should I lock up long-term? I'm like, what are you going to lock up 10? Yeah, the next 4 years may be low, but what's 6, 7, 8 going to be? Do you want to maybe jump into that? So that's why the laddering is great. So you have one at 10, you have one at 7, and you have one, you can overall blend your yield on those things. And remember, a lot of these do have access. And if you use that access, there's 3 types of access, right? And you either have 10% free withdrawal, you have interest withdrawals, and there's one that no one really talks about. I really like is the cumulative interest withdrawal, right? You guys understand that is, hey, if you don't take your withdrawal, it accumulates. So all interest can be withdrawn at any time. So if you got a good interest rate in the 9th year, you might be able to pull 60% of that money out and move it somewhere or at any time. So cumulative interest withdrawals might be a really good thing right now as rates are higher. But if they continue to get higher, you can pull a chunk out. Or if the markets plummet and you have qualified money and you have 70%, you maybe want to jump into the market if the markets are down 40% or something. So,
yeah, well, it's interesting. Like these product design changes kind of track each other across these products because I saw that exact same feature creeping into the FIAs of the last year, where I've got an annual free withdrawal amount. Say it's 5%, 10%. If I don't take it the first year, it spills over. So I think,
yep. Fraternals are really good at that.
Yeah. Yeah. Well, why don't you walk us through some of the concepts? So, I mean, hey, it's easy to sell these things when interest rates are 6%. Bruno, would you like 6% for 5 years? Right. So interest rates start to come down. You got to be a little more thoughtful, I think, in terms of how you position these products. So for those people who say, okay, rates are down, I can't, throw a big number on a website or a call. Jeff, talk to us about some of the concepts that you talk about and share with clients and agents.
Absolutely. And you'd think 6% would be an easy sell, but people are like, no, I'll wait for 8. It's always that way. You don't know how many times 5 for 5 was like magic 5 years ago. If I can get 5 for 5, everyone's going to buy it, right? Add 5 for 5. No, well, let's see. The S&P is now 10. We'll go. So yeah. And okay. So MYGA clients are different. MYGA clients are CD clients. So a CD client, if rates go down, CD rates go down. So hopefully the MYGA is always better, as long as we're not in an inverted yield curve. We usually can do better. Since I've been in this business, I've never not been able to get someone at least 3% in a MYGA. So it's the bank clients that want tax deferral. It's not the investment guys that are going to go to a MYGA. They might at 6. You might say, hey, this is a good hedge for me. But when rates are 3, it's not going to be the same client. It's going to be your safe client who's getting 0.1 in their checking or savings account. So that's where you're going to switch your marketing. Right now, you can market MYGAs to everyone. When rates are lower, you're going to want to stick to the super risk adverse clientele. I don't know. Does that make sense?
Oh, yeah. Yeah.
Because it's a commodity.
Absolutely. No, absolutely. And what about ways to use MYGAs as lifetime income and retirement income? You've also posted on that on that particular topic. What caught my attention is the age at which some of those people should start thinking and buying these things. And we're not talking about the baby boomers. We're talking about people in their 40s. What that would look like today. I'm 40 years old. I
can't wait for this one. Let's hear this.
So there, you had some very interesting propositions there. A lot on the on the give and take in terms of the various dynamics, returns and longevity. Can you explain and get a little deeper in those type of strategies?
Yes. Sorry, I was
younger folks.
Yeah, I was trying to pull up the number. Well, I just didn't mean to show it. So there's 2 things we can do for younger people. So the MYGA, you can just take out withdrawals. So I did an example. This was a 60-year-old, and the rate was 5.05 for the first 10 years on the MYGA. And we're going to take out $40,000 annually at the end of each year. Right. And how long do you think it will last for this 40-year-old before they hit that? It's $1 million premium. How long before they invade that million on the current guarantee? And it turned out to be age 87. So 27 years because of the minimum guarantee being high at that 3% level. So that's one way to take money out of a MYGA without ever invading your principal, is just stripping the interest with a high minimum guarantee. So this was $40,000, 27 years, and they never invaded principal. Guaranteed. Day one.
Okay, wait. So 40-year, I'm really interested.
This is 60.
In
this one was 60.
Oh, 60.
The 40-year-olds were using the DIA, the deferred immediate annuities. And what that does is I ran a 40-year-old male who wanted $100,000 of income at age 65. The premium was $371,000 today. The guarantee was $1 million. The catch with those is you got to be alive when the income starts. Otherwise, you lose all interest and it goes back to premium. So you can't lose your premium. The $371,000 the person put in is the minimum guarantee back. But should they live to that 65th year and day one get one payment, they just guaranteed $1 million because you're doing life in 10. So that $100,000 for 10 years, right, is $1 million. And
that kicks in at age 65.
At age 65, right? All guaranteed today. So 371 today guarantees this person $100,000 a year for as long as they live to 110. Great. But if they died the day after starting the payments, their clients, their heirs, their beneficiaries would continue to receive the payments until it equaled $1 million. So that's the only catch. So that's
okay.
The catch.
But you'd have to wait until 59 and a half to start taking that, right?
No, because it's annuitized, right? It's life.
Is that it?
It's annuitized. So you got lifetime substantial equal payments based on life expectancy. It's annuitization. You could do it at age 40 if you want. You can annuitize at any time.
But a withdrawal, I get penalized for if I did it at 40.
Exactly. You get your 10% excise tax. There's no. Now you can't have a guarantee on a SPIA that exceeds life expectancies. There's a couple rules at the IRS. They don't want you taking too much. But yes, you can annuitize at any time. And this is really great for split annuities, because a split annuity says even at 40, you can take the money out as long as it's cash going in, right? And it's immediately annuitized. So
Yeah, well, hey, let's talk about let's double click into that one a little bit, because right from what I understand talking to you, that actually could be a solve for bridging to retirement. So say I'm working for the federal government, because guess what? Like I have family who got, they lost their job here, but so yeah, you're suddenly 50, 56, 57, you lost your job, you're trying to maximize your Social Security. Jeff, how would there are FIAs that will do this, but tell us how we'd approach it with a MYGA or a DIA, some sort of a MYGA, SPIA, DIA combo.
Well, you can do a SPIA just for, say, the difference of time and buy that.
Yes.
Say, I need $3,000 a month until I hit age 67. We'll price it out today, and hopefully they have enough money to cover that. It can be done 100 different ways. A SPIA is just one to do it, guaranteed. On non-qualified money, the good thing about the SPIA is, and everyone should know this, exclusion ratio, right? So on a 7-year period, certain 100% of that money being taxed already, you could have as much as the $3,000 income coming back at 90% tax excluded. So the idea really for the split is for people that are in a high tax bracket, maybe not lost their job, but are currently they need a little extra money to take care of the additional inflation expenses that have come up lately, which is substantial for some people. If their income is level, even if it's $250,000 a year, it's still level. They have their expenses. They need a little extra cash, but if they take it out as all interest, it's at 30, 40% taxable. So you do a split, you put $500,000 in, put the difference in the MYGA to grow back to 500, buy the SPIA, and that income's going to be excluded from tax. And then you hit Social Security, and you're hopefully at a lower tax bracket.
Yeah, you hit a really good point here on inflation, and I love your position there. Let me explain my background. I was on many committees, actuarial committees, and the rule of thumb is, well, not the rule of thumb, but the common belief is that SPIAs are bad because they're not inflation protected. So you get a certain payment, and that payment is flat, and that's bad because it's not inflation adjusted. And my rebuttal to this is, what's your alternative? And if you live a very long period of time, you keep on getting those payments where the alternative may turn out to be zero. This is very, very steady. So if you just buy either more lifetime income for either later ages or now, you actually protect it. It's actually a tool against inflation, even though it's not inflation linked per se. I'm sure you have a lot to say about that topic of retirement income payments and inflation. And I definitely want to hear your thoughts and position on that.
There's two thoughts I have on that. Number one is, if you're taking money today at a higher than you could just investing and being safe, 4% rule, if you can take out 7 on the SPIA, kind of ahead of inflation already, right? But then there's the other thing. I've actually priced this out. I don't have the numbers in front of me, but I priced out $40,000 compound COLA, cost of living adjustment on a SPIA, 2% compounded annually. So your $40,000 a year is going to grow by 2% annually for life. It still costs less than $1 million to fund this today with high quality carriers. So yeah, you're ahead already, but you can also build in your own inflation protection. And the way inflation protection works best on SPIAs is for people with money. It's not really for people without money that are trying to get the maximum income today. They're not going to want a COLA because they're going to say, I have 100,000. How much does that give me? Well, it gives you 500, but with the COLA, it only gives you 400. I'll take the 5. But the person's like, I want 3,000 a month and I want it to go by this. I don't care what it costs. Those are the people that are really for a COLA, because you're going to build, you're buying the income and you're COLAing it. And then you're going to price that out. So it's really for the more wealthy people. Yeah, absolutely. You can guarantee a 5% COLA. It gets very expensive. 2% seems to be the hot spot. And that will give you, and I've done the numbers. I can send it to you guys later if you want to see them, but it's exponential. If you live to it's a longevity. If you die early, it doesn't work. You live to 95. These things are amazing. Your 40,000 is like $70,000 a year, right? If you have 40,000 at 2% interest and you live 25 years, you're at $65,000 of payments now. Your 40s now, so it's going up. So that's the best way to guarantee an inflation protection. And then the other way with MYGAs, my mom owns these and uses them to strip the interest to make her living, right? To live off of without touching the. So she was stripping at 3.65 before. Now she's stripping at 5.4. Inflation was like 14, 16. Her increase was 20. So technically, in a way, she beat inflation with these new rate increases. Now it could invert in 5-7 years, but right now she just got huge increases of 40% on her income because the MYGA rates went up. So, I mean, inflation is a great talking point for people who are anti-annuity, I think, and want, and they don't want to get into the longevity conversation of it all. There's a lot of anti-annuity topics out there to try and pull people away from these, I'd say, lower commission products, really.
Right. Yeah. So like if we kind of thought of features, I had a conversation where somebody said, how pretty would have loved this yesterday. How complicated is the MYGA? I'm like, well, let's see. Okay, so and Jeff, here are the changes I saw in just the last couple of years. One was compound versus simple interest. I've got a really big simple interest number. Well, you've got to illustrate this thing out. Okay, and probably depends on your interest strategy, withdrawal strategy. Which one's better for you? That was interesting. That you mentioned the kind of the cumulative annual free withdrawal. I've seen that. I've seen death benefits sort of change. Put the rate into the product, but the death benefit's really the surrender value. So don't die year 3, die year 5. So what else? I mean, MYGAs. We've seen these MYGAs. What are the other edges people are playing with right now in these products?
All right. Death benefit, surrender value. The insurance companies came out with some tricky features to raise rates when they were really low. Rates were so low, they had to pull features off. So a 10% free withdrawal, which most people never use, costs 8 basis points, let's say, for their actuary pricing. So, hey, if we add it as an add-on instead, we can get more yield. Today, we don't need these bells and whistles, if you will, or these features because rates are back up. So if you have one of them that has a surrender charge of death, if you read the contract, which I'm a huge fan of reading contracts, it says an endorsement that says you can waive this surrender charge of death if you take 5 years of annual payments. No one knows about this. So there's intricacies inside of all that. What was the other thing you mentioned? With rate, you mentioned
compound versus simple.
That's been around for a long time. So you just got to do the math. That's a mathematical equation. Once I do the math, I give you the equivalent yield. So anytime it's simple, they should give you the APY equivalent, and that make everything simple. Because I've had people call it's 6%. I'm like, yeah, but it's simple. And then if you have a simple interest contract, any insurance company, if you're designing a simple interest, do not allow withdrawals because everyone's going to withdraw the money. So I think there was a company that came out with a simple interest and what did they see? So all the money's going to walk out because it's not going to earn interest if you limit there. So a simple interest contract should never have a free withdrawal provision because that hurts the insurance companies. That's how they built their profit model. Like that money sitting there at no interest, right? And then the MYGA is I think they market these things wrong. They market them as MYGAs instead of FIAs. It should be an FIA with a 4% floor, right? This is, again, not new. USG, remember USG? They're not around anymore, so I can use their name. They had a MYGA, an FIA called the Secure 7. And the Secure 7 had a minimum guarantee of 100% at 3. It's nothing new. They're just saying it's 4 now, right? But it's the cool thing about the 100% at 3 that's better than the MYG 4 at the end is the death benefit. If you have 2 down years, you add the 6% in the death benefit. So it was an actual return. So the minimum guarantee will forever be the strongest guarantee inside of any contract. And the higher the minimum, the better, of course. So I hope this touches on the few things. And the 30-day window is the next thing they've put into MYGAs, which I don't like. Because how do you do suitability if I can't get it? This has happened to me. Like I don't want my client staying with this company because I heard something about it. I can't get in touch with the client. I tell the company I don't want them to renew. They're going to renew them anyway. How is the suitability there? Whereas if it's liquid, you have that big time frame and you can adjust. You can take time if you have a window and say,
Right.
hey, look, rates are going up in 2 months. I think let's just sit here at 1.5 until rates go up, instead of having that 30-day have to hurry, move. Conversely, though, the agents, hey, I got to move this money in 30 days. I get a new commission. So there's always the two sides. I'm in the middle. I have the companies over here and the agents over here. So I have to protect both of you guys.
Oh, fair enough. That makes sense. Any positive talk on risk pooling? And here's where I'm coming from. In the examples that you put together, you have, you put in $1 million, and you guaranteed X, and your only downside is the loss of investment returns on those if you die earlier. So I completely understand like the dynamic here. What if we were to take it a step further and say that if you die in that middle period, you get nothing, like not even the principal back? Obviously, that's a downside for the policyholder because, you put a large chunk of money and there's a reasonable chance you'll never see back a penny of it. But what if that chunk of change is lower, and in a way that maximizes every single dollar after you're, let's say, 65 or whatever age that is? How is that conversation going? And I know there's a lot of like psychology in the policyholder. I know there's agent comp. There's just so much going on in that particular dynamic. But I'm again very curious to hear what are your thoughts? What is the appetite over the long run?
You mean like in the regards to an immediate annuity where it
Yes.
ends? So that's a life only. It's the most
Yes.
dangerous product. It's the most dangerous annuity there is, because you could literally put in $1 million, get 5,000 back, and die and have nothing. The insurance companies have been kind of wise to this, and what they've done is they've adjusted their pricing to make, like, depending on the age of the client, a life in 10 more profitable, more income to the client than a life only. They don't want you selling life onlys. And when we do say a life only, that extra bit should maybe used to be buying life insurance. Maybe you have a life insurance component on the other side, even if it's a small amount to cover 15 years down the road, whereas you're going to have your payment accounts going down, but your life insurance will meet it at one point, whereas the death would have occurred, zero here, but it's going to give you the $250 you would have had anyway in the other policy. Otherwise, I would say just go for the refund option. It's like the zero return, and it kind of meets in the middle, whereas you get a pretty good payout, but you're not guaranteed any gain. And then you get into the long-term period certains where you can go up to 20 years and guarantee yourself some substantial gain should you die to the beneficiaries. So remember, these are longevity products. If you buy a life in 10 and you live 11 years, you just paid for 10 years of insurance you're never going to need, and it forever will be a lower payment. But I personally think the life only is extremely dangerous, and I require 2 extra disclosures for any life onlys we write, including like your family understand you're buying a life only, because it might not be worth it for that $20 a month.
There's a lot of talks about, should those SPIAs, should you look at should you use investment returns as a metric, return on investment as a metric for those? And you're right. It's a very dangerous product, because if you die early, the return on your investment is going to be very bad. And there's a lot of talks that says you should never look at the investment return on those because they're insurance. Just like you wouldn't look at the investment return on your car insurance policy. It's like, oh, I paid $1,000, did not make an accident, and my investment return is negative 100%. But at the same time, like where I'm fascinated is that the SPIA, the life only annuity, is a combo of an investment product and and risk pooling, and from a concept perspective. So do you encourage looking at that investment return on those particular products, or you're saying it should be ignored because it's not relevant?
Yeah, that's a securities mindset. I think it's not an investment at all. It's pure insurance, and it's just purely insurance. That's 100% of the way we're going to look at these, and it's the way to look at a SPIA is the same way I've looked at a SPIA the whole time. Where else can a 65-year-old male pull out 7.2% of his money and guarantee he'll not outlive it? Where else can you do that? There's nowhere else you can do that. And then if you can put a guarantee that, hey, not only can you pull it out at 7.2, but worst case scenario, you zero out your return, your money back guarantee. Or, or you'll lose all your money. You'll lose whatever you don't take. And at that point, it's like an extremely risky investment. And if in an extremely risky investment, you want to make 25, 30%, right? You're not making 25, 30% on this risky annuity investment. You do better to take the smaller hit and guarantee your premium. Unless you're just, you have life insurance and I got 300 buildings I'm going to sell to my kids. I don't care. I just need the maximum income. If I die, I don't care. And then disclose that. This is why I'm buying this. And then maybe take the difference, what a life with refund would have cost, and do something and invest that, more aggressively. Yeah. Again, the idea of investment is, hey, a lot of people tie up $1 million to take $40,000 a year. You can tie up $600,000 to take $40,000 a year, and then go get super aggressive with the rest of that. That's a better way to look at using the SPIA for investments. Yeah. Guarantee my income investment. Now let's go 17 black. Let's go whatever it is, because your income's guaranteed. You can't lose. Yeah.
Listen. That'll be my strategy in retirement. Hey, look. No, we've got about 5 minutes left here. Just switch gears a little bit, Jeff. Last time we talked, I've been working for carriers forever. Now I'm on the tech side, which is actually having a lot of fun here. And we've helped a couple of new companies get into the market, soup to nuts. They had capital, they had some shell carrier or technology went up there. If I'm sitting across the table from somebody who says, listen, I've got cash, Paul, should I enter the MYGA business? What's your recommendation? Oh, it's too crowded, stay away.
Yeah, I would definitely say enter the MYGA business. Most of the companies are focused on fees, RIAs, all the new products seem to be in FIAs with non-traditional fixed annuity values, in my opinion. They're more geared toward the securities mindset, whereas a MYGA is geared toward the banking mindset. So you come out with a MYGA, you got a good name too. There's definitely room in the MYGA space, but you got to be competitive. You're not going to come out with a MYGA, be a 15th place, and think you're going to sell a lot of MYGA. Unless you have a captive agency, that's pretty, unless you're going to be a captive insurance company. But yeah, I definitely think there's room in the MYGA place. And if people are smart, you'll find holes in your portfolio and come out with a 56-month MYGA. Why does everything have to be exactly a year long? Why can't there be a 4.5-year MYGA? Used to be. The investment guys would go to say, what do you need? Oh, man, we got a hole in our portfolio, 40 months. All right, come out with a special $10 million, 5% for 40 months. So yeah, I think there's a lot of room in that, especially if you can move quickly and change your rates with the environment and stuff.
Yeah. Well, hey, this is great. Bruno, we're just about out of time. Any last questions for Jeff or thoughts here?
No. I think keep on the education, keep on the posting, keep on the presence there, and elsewhere as well. So very useful. So it's very tangible. So that's really good.
Yeah, I'm trying to get out there and teach people because a lot of misunderstanding in the basics. So. And the QLAC, we didn't even touch on QLAC. So everyone look up at the rules of QLAC. You're an agent. QLAC is hot right now. Hot place to be.
Oh yeah. Well, listen, I definitely want to have you back. We had, Ben Fott from Ocean View on. Boy, would that be? Yeah. Yeah. Well, that would be interesting. For get these two guys together and I bet design a MYGA while we sit and watch. That'd be great. So Jeff, I don't know. Listen, what's the best way for anybody to find you, listen to you, get in touch if they have questions or interest or interested in either selling or buying one of these products?
Selling, buying, learning about them. I'm happy to help. My name, Jeff Affronti. You can simply Google my name and you'll find me a million times. Find me, Google my name in YouTube. I got a channel there. I do fixed annuity news and reviews. I've been doing news and reviews for almost 20 years now. So I go through products and details and real life situations that have happened and stuff like that. So that's where you can find me. Just Google me. It's easy.
Cool. All right. Jeff, Bruno, thanks so much. And listen, thanks to all our listeners. Give us feedback. And most importantly, join us again next week for another great episode of That Annuity Show. Thanks.
Thanks, Paul. Thanks, Bruno.
Thank you.
Nassau Financial Group is always working harder to be your carrier of choice. We build products that help protect people's savings and are dedicated to providing you with best-in-class service. We seek to keep things simple and have your back in the years to come. Nassau is headquartered in Hartford, Connecticut. Learn more at nfg.com.
Zinnia, an Eldridge Industries business, simplifies insurance. It delivers comprehensive solutions for the industry's most critical needs and creates the modern rails of the insurance industry. To learn more about Zinnia, please visit zinnia.com.